Welcome to the deep dive. Today, we're really getting into a topic that, well, it touches pretty much everyone, investing.
Absolutely.
But we're aiming deeper than just, picking hot stocks. We want to explore what it actually means to be an intelligent investor.
Mm-hmm.
We'll be leaning heavily on Benjamin Graham's classic, The Intelligent Investor, timeless stuff. And we're also pulling in insights from articles on contrarian thinking and how successful billionaires approach things.
Yeah, and Graham is the perfect foundation for this. His work isn't just about spreadsheets. It's about the mindset, the psychology.
Exactly. So, our mission today, let's try to extract the really powerful, actionable ideas from these sources. We want to help you understand why thinking differently, going against the crowd, can be so effective.
And how to actually do it intelligently.
Yeah.
Because contrarianism isn't just being stubborn. It's applying Graham's discipline.
Okay, let's kick off with something that might surprise people. Graham argues right at the start that being an intelligent investor, it isn't really about having a genius-level IQ.
Not at all. It's not about your grades or test scores.
It's about temperament, character.
That's the key word. Graham called it being practical vyavaharic, as you might say. Having the right emotional makeup, the right understanding. It's distinct from just raw brain power.
And Graham uses this incredible story to illustrate it. It involves Sir Isaac Newton.
Oh yeah, the Newton story is fascinating and, frankly, a bit scary.
Right. One of the smartest people ever.
Undeniably. So back in 1720, Newton gets involved with the South Sea Company stock. Big bubble happening. He buys some shares early on, sees them go up, and sells for a decent profit.
Okay, sounds smart so far. Made money, got out.
You'd think. But then the stock just kept going up like crazy. The frenzy continued, and Newton, seeing everyone else apparently getting rich, he started feeling like he'd missed out. Big time. FOMO, fear of missing out.
Even Isaac Newton wasn't immune.
Wow. Apparently not. So, despite his initial good sense, he jumps back in, buys more shares. But this time,
Let me guess. Right at the top.
pretty much, he bought back in at a hugely inflated price, right near the peak of this massive speculative bubble.
Oh, the classic mistake. Buying high because everyone else is. What happened?
Predictably, the bubble burst violently. Newton ended up losing a fortune, something like 20,000 pounds back then, which, adjusted for today, could be billions.
Billions. From the guy who figured out gravity.
Yeah. Apparently, he was so crushed he didn't want anyone to even say South Sea around him afterwards.
How does that happen? How does a mind like that make such a, seemingly basic emotional error?
And that is Graham's entire point. Newton was brilliant, intellectually off the charts. But in that moment, he wasn't an intelligent investor.
Because
He let the crowd's emotions, the excitement, the regret, the greed override his own judgment. He abandoned his rational plan and just followed the herd.
So investing intelligence is really about controlling your behavior, not just flexing your intellect.
Precisely. It's behavioral discipline. Emotional control. That's what separates the intelligent investor from, everyone else caught up in the madness.
And that madness, that herd mentality, it's just human nature, isn't it? We feel safer in a crowd.
We do. It's wired into us. And in the markets, that translates directly into FOMO when things are going up.
And panic selling when things go down.
Exactly, which leads to that disastrous pattern. Buy high, sell low. The crowd piles in when prices are soaring, pushing them even higher, often unsustainably.
Right.
Then, when fear takes over or the market corrects, that same crowd stampedes for the exit, selling at a loss.
And you could argue today with social media, 247 News, these online echo chambers, it's even harder to resist the herd, right?
Oh, absolutely. The echo chamber effect is powerful. It just amplifies whatever the dominant sentiment is, whether it's euphoria or terror, and makes it really tough to step back and think independently.
Which leads us nicely to the antidote, contrarian investing, thinking against the crowd.
Essentially, yes.
Yeah.
A contrarian investor deliberately goes against the prevailing market wind. They're looking to buy when most people are pessimistic and selling.
And maybe selling when everyone else is wildly optimistic and buying.
That's the core idea. The belief behind it is that markets aren't always rational. They get driven by mass psychology, fear, and greed.
So assets can become seriously mispriced.
Exactly. Periodically overvalued or undervalued compared to their real worth. The contrarian sees those emotional extremes as opportunities. When panic drives the price of a perfectly good asset way down,
They see a potential bargain.
right, they're looking below the surface noise,
Right.
anticipating that eventually sentiment will shift back towards reality.
Okay, so it's not just being difficult. It's a strategy based on perceived market inefficiencies driven by emotion. And Graham's work provides the toolkit for how to act intelligently, which often looks contrarian.
Perfectly put. His principles give you the framework. And maybe the best tool he gave us for understanding market mood swings is the Mr. Market analogy.
Ah, Mr. Market. I love this one. Explain it.
Okay, imagine you co-own a business with a partner named Mr. Market. Every single day, this guy shows up, and he offers to either buy your share of the business or sell you his share. But here's the catch. Mr. Market is, well, emotionally unstable. He's got wild mood swings. Some days, he's bouncing off the walls with optimism, telling you the business is going to the moon and offers you a ridiculously high price for your share.
Like during a bubble.
Exactly.
Yeah.
Other days, he's utterly convinced the sky is falling, the business is doomed, and he offers to sell you his share for pennies on the dollar.
So he's basically the market's collective emotion personified and bipolar.
Pretty much. Now, Graham says the intelligent investor's response: treat Mr. Market like a convenience, not a guide. You don't have to trade with him just because he shows up.
You can just ignore him.
You listen to his offer, sure. But you only actually transact with him when his mood, and therefore his price, is clearly advantageous to you. Meaning you buy from him only when he's deeply depressed and offering you a bargain price, way below what you think the business is actually worth. And you might consider selling to him only when he's irrationally exuberant and offering you a crazy high price.
So you exploit his mood swings instead of being swept up by them.
That's it. You focus on the business's real value, not Mr. Market's daily drama.
And that's pure contrarianism in action, right? Buying the fear, selling the greed.
Fundamentally, yes. And the key to knowing whether Mr. Market's offer is good or bad relies on another core Graham concept: intrinsic value.
Okay, so this isn't just the stock price blinking on the screen.
No, definitely not. Intrinsic value is your best estimate of what the underlying business is truly worth. It's based on fundamentals, its assets, its earnings, its debts, its future prospects. It requires real analysis.
You have to do the homework to figure out what it should be worth, separate from the noise.
Correct. The intelligent investor focuses on that intrinsic value calculation. The market price is just what Mr. Market is offering today.
And once you have a sense of that intrinsic value, that leads directly to maybe the most important concept: the margin of safety.
Absolutely critical. Think about building a bridge. If it needs to hold 10 tons, you don't design it for exactly 10 tons.
No, you'd build in a safety factor, make it hold 15 or 20 tons.
Exactly. That extra capacity is your margin of safety. In investing, it means buying an asset only when its market price is significantly below your calculated intrinsic value.
So if you figure a stock is worth, say, 100?
You wouldn't buy it at 95. You'd aim to buy it maybe at euro 70. That difference, that 30–40% discount, that's your margin of safety.
Why is that so important?
It's your buffer. It protects you if your intrinsic value calculation was a bit off. It protects you if the company hits unexpected trouble. It protects you if the whole market takes a dive. It builds in potential profit right from the start and dramatically reduces your risk.
And buying something for 60 cents when you think it's worth $1 is inherently contrarian, especially if the reason it's cheap is because everyone else is panicking.
Precisely. It's a defensive move that relies on going against the fearful crowd.
Now, Graham also talked about different types of investors, didn't he?
He did. He distinguished between the defensive investor and the enterprising investor.
What's the difference?
The defensive investor is primarily focused on safety and avoiding big mistakes. They want reasonable returns, but aren't looking to spend huge amounts of time on research. It's more passive.
Okay. And the enterprising?
The enterprising investor is willing to put in significant time, effort, and skill to try and achieve better than average returns. They're actively searching for specific opportunities.
I suspect most listeners probably identify more with the defensive approach. What did Graham suggest for them?
Several key things. First, diversification. This is huge. Don't put all your eggs in one basket.
Meaning?
Spread your money around. Own different types of assets, stocks, bonds, maybe some real estate exposure. And within stocks, own a good number of different companies, maybe 10 to 30, across different industries. Don't bet the farm on one stock or one sector.
Makes sense. What else?
A consistent approach. Decide on an asset allocation like maybe 50% stocks, 50% bonds, or whatever fits your risk tolerance and goals, and stick to it.
Don't try to time the market based on headlines.
Exactly. And rebalance periodically, say once a year or quarterly. If stocks have done really well and now make up 60% of your portfolio, sell some stocks and buy some bonds to get back to your 50-50 target.
So rebalancing forces you to sell high and buy low in a disciplined way.
It does. It imposes a kind of automatic contrarian discipline. Third, focus on quality.
What does quality mean in this context?
For the defensive investor, it means sticking to large, established companies. Look for businesses with a long history of profitability, say, at least 10 years. Maybe a history of paying dividends for 20 years or more, which suggests stability.
So, solid, proven businesses.
Right. And check their balance sheets. Do they have more assets than liabilities? Is their debt level reasonable? Focus on companies making things people actually need, not just speculative ventures.
And how does valuation fit in for the defensive investor? Are they still looking for bargains?
They're not necessarily deep value hunting like an enterprising investor might, but they do want to avoid paying wildly excessive prices. So looking at basic valuation metrics like the price to earnings PE ratio.
How much you pay per dollar of earnings?
Right. Or the price to book, PB ratio price, relative to the company's net assets. Graham suggested defensive investors should look for companies with reasonable PEs and PBs, avoiding stocks that look extremely expensive by historical standards. It's another layer of safety. Quality at a fair price, not quality at any price.
So the defensive path sounds like diversify widely, be consistent, focus on quality, don't overpay. Seems sensible. What about the enterprising path?
That's a whole different level of commitment. It means doing deep dives into individual companies, maybe smaller ones the market overlooks. Looking for special situations like mergers or restructurings. It requires significant research skill and time.
It sounds like where the really big fortunes could be made, but also where big losses could happen.
That's a key point from the sources. While many ultra-wealthy people initially built their fortunes through deep concentration in something they knew extremely well, that same concentration is also responsible for most spectacular investment blowups.
So for most people,
Diversification, the defensive route, is generally the much safer path to building and protecting wealth over the long run.
speaking of protecting wealth, we have to talk about inflation.
The silent thief. Yeah, absolutely crucial. Inflation just eats away at the purchasing power of your money over time.
The sources use an example like 10,000 10 years ago might only buy, what, say 40,000 buys today, something like that.
The exact numbers change, but the principle is solid. Cash sitting under the mattress or even in a low-interest savings account is constantly losing real value.
Which is a powerful argument for investing, right?
It's essential. Assets like stocks or real estate have historically provided returns that outpace inflation over the long term. Moderate inflation can even be okay for stocks sometimes, as companies might raise prices.
But high inflation can hurt.
Yeah, high inflation can squeeze consumers, hurting company profits. The sources also mention real estate investment trusts, or REITs, as potentially offering some inflation protection through rising property values and rents.
The bottom line is, staying in cash long-term means you're likely falling behind.
Almost guaranteed over long periods. Which brings us back to the need for a long-term perspective.
This seems like the bedrock of Graham's whole philosophy.
It absolutely is. Intelligent investing, value investing, contrarianism, they only really work if you have a long time horizon. Compounding earning returns on your returns needs years, decades, to really work its magic.
And this is the complete opposite of
Speculation and trading. Trying to jump in and out of the market daily or weekly, trying to predict short-term swings based on charts or news. That's not investing, it's speculating.
The sources compare it to gambling.
Pretty much. They mention maybe 50 odds before you even account for trading costs and taxes. It's stressful, time-consuming, and the evidence suggests most people who try it lose money.
Even the experts struggle to time the market consistently.
Exactly. The sources cite examples of very smart people failing at it. The only real certainty seems to be that the future is unpredictable, and trying to outguess the market minute by minute is likely a losing game.
Which loops us back perfectly to Newton and the absolute necessity of emotional control.
The investor's biggest challenge. Fear makes you want to sell everything when the market tanks, locking in losses. Greed makes you want to chase stocks that have already shot up, buying high.
So you need the discipline to override those instincts.
You have to. Stick to your rational plan, your chosen strategy, your asset allocation, despite the market's volatility. Don't let Mr. Market's moods dictate your actions.
And underpinning that discipline is doing your own research and analysis.
You can't just rely on tips or rumors or what some analyst paid to be bullish says. You have to put in the work to understand what you own.
Know the business, its prospects, its value.
Base your decisions on facts and calculations, not hope or hype.
And this disciplined, research-driven, often contrarian approach, it's visible in how many really successful investors operate, isn't it?
Definitely. The sources highlight several. Warren Buffett is the obvious one, a direct disciple of Graham, his famous line, "Be fearful when others are greedy, and greedy when others are fearful."
That's the mantra.
Think about him buying American Express during the Salad Oil scandal, or investing heavily in Goldman Sachs right in the teeth of the 2008 financial crisis. Pure contrarian value plays based on fear creating opportunity.
Who else?
Michael Burry, the guy from The Big Short.
Yeah.
He did incredibly deep research into the subprime mortgage market back in 2005, saw the rot when everyone else was partying, and bet against it. Hugely contrarian.
Yeah.
The sources also mention Donald Trump in real estate, often looking for distressed or undervalued assets that others overlooked, seeing potential where others saw risk.
A different asset class, but a similar contrarian mindset, maybe.
Arguably, yes. And even Bill Gates, his early focus on software for personal computers was completely against the grain of the mainframe-dominated tech world back then. He saw a different future.
So what are the common threads? What enables this kind of thinking?
The sources point to a few things. One is calculated risk-taking. It's not reckless gambling. It's based on deep research, understanding the odds, looking for asymmetric bets where the potential reward outweighs the risk.
And having a buffer.
Crucially, yes. Having the financial stability to take a hit if you're wrong. Another is fiercely independent thinking.
Questioning everything.
Questioning everything, including their own assumptions, doing the analysis themselves, forming their own opinions, and turning out the market noise and short-term chatter.
And the third?
Patience. Huge patience. Willingness to wait for the right pitch, the right price. And then waiting, sometimes for years, for the market to finally recognize the value they saw initially. No chasing quick profits.
Okay, so we don't need billions to adopt the mindset. How can the average person apply these ideas practically?
Well, first, develop your own research skills. Learn to read financial statements, understand business models.
Define your own investment philosophy and stick to it. Don't just follow fads.
Exactly. Practice emotional discipline. When the market goes crazy, pause. Reflect. Stick to your plan.
See downturns not as disasters, but as potential opportunities to buy quality assets cheaper.
All right, diversify beyond just what's trendy right now. Seek out information that challenges your views. Don't just live in an echo chamber. Though, do it responsibly. Look for credible analysis.
Focus on long-term value creation, not short-term price movements.
And critically, build that personal financial stability emergency fund, manageable debt. That gives you the buffer, the staying power, to ride out volatility and make calculated moves without being forced to sell at the wrong time.
Okay, let's touch briefly on the nuts and bolts. How do people actually do the buying and selling?
The sources mention the basics. Online brokers have made buying individual stocks very accessible, often with low costs and low minimums.
Less common now, but direct stock purchase plans from companies were also mentioned.
Right, but for many, especially defensive investors, mutual funds or index funds are a great option.
Because they offer instant diversification.
Exactly. You buy one fund and you own tiny pieces of hundreds, maybe thousands of stocks or bonds. Index funds, in particular, just aim to track a market index, offering broad exposure very cheaply. It takes away the need to pick individual stocks.
What about bonds? Any practical tips there?
Yeah, a few things. If you're investing outside a retirement account, consider tax-free municipal bonds if they make sense for your tax bracket.
Because the interest isn't taxed federally.
Correct, sometimes state and local too. Also remember that bond prices generally move inversely to interest rates. When rates go up, existing bond prices tend to fall. Short-term bonds are less sensitive to this than long-term bonds.
So maybe stick to shorter durations if you're worried about rising rates.
That could be a strategy. Bond funds are often easier than buying individual bonds as they handle diversification and reinvestment for you.
Any types of bonds to be wary of?
Well, junk bonds, high-yield bonds from less credit-worthy issuers. They pay more interest but carry much higher risk of default. Probably not for the core of most portfolios. Maybe a tiny slice for income if you can tolerate the risk. Same goes for some high-risk emerging market bonds. They might add diversification, but the risks are significant.
The overall message seems to be, apply diversification to bonds too. And that idea of being 100% in stocks, probably not for most people.
Graham and the sources are pretty clear on that. Unless you meet very strict criteria, huge cash reserves, decades-long time horizon, proven ability to withstand crashes without flinching, having some allocation to bonds provides crucial stability and reduces overall portfolio risk. For most investors, a balanced mix is much safer.
And one final practical point, financial advisors.
Use them cautiously. Do your due diligence. Check their credentials, how they're paid. Are they fee-only fiduciaries who must act in your best interest? Or do they earn commissions selling products?
Red flagged.
Anyone promising guaranteed high returns? Anyone pushing complex products you don't understand? Anyone using high-pressure tactics or calling things a once-in-a-lifetime opportunity? Be skeptical.
And ultimately, don't outsource your understanding.
Never. It's your money. You need to understand the basics of where it's invested and why. That's part of being intelligent about it.
This has been really insightful. It feels like the core message is that true intelligent investing is less about complex formulas and more about mastering your own psychology, sticking to sound, time-tested principles, and sometimes having the courage to stand apart from the crowd.
Exactly. Patience and discipline are key. The market will do crazy things up and down, but a well-thought-out plan focused on value, diversification, margin of safety, and the long term, that's your anchor.
Graham apparently liked a quote from G.K. Chesterton, rephrasing it slightly. "Blessed is the man who expects nothing, for he shall enjoy everything." Maybe there's a lesson there for investing. What if we stopped chasing guaranteed riches or expecting the market to always go our way?
Focus on the process,
Yeah.
the discipline.
Yeah. What if focusing on executing a sound strategy, managing expectations, and finding satisfaction in the disciplined act of investing itself rather than just the outcome? What if that actually leads to better results and, well, more enjoyment in the long run?
That's a deep thought to end on. Manage the process, manage yourself, and the results might just take care of themselves over time.
So for everyone listening, think about how you can apply these ideas. How can you cultivate that intelligent temperament, focus on value and safety, and maybe, just maybe, find the courage to think independently when Mr. Market gets emotional? How can you be less like Newton in the bubble and more like the intelligent investor Graham described?